Hello, this is Sergio Marrero, and here for another episode of RBL1 Live with the CEO of Camino Financial, Sean Salas. So thanks for joining us tonight, Sean.
I'm glad to be here.
And for those that don't know about Sean, I'll share a little bit about his background. He's a graduate of the University of California, Berkeley, also a fellow alumni from Harvard Business School, has a background working in investment banking, also private equity before he ventured out as a founder, starting Camino Financial with his brother. They've raised over 125 million in debt and equity since their inception, and excited for him to share his story with us today. So thanks for joining us. I'll turn it over to you, Sean, if you can share with the audience what is Camino Financial.
Great. Well, first and foremost, thank you for having me here. It really is a pleasure, and seeing so many great and colorful and diverse investors, entrepreneurs. It's always good to be speaking to our community, and so thank you for that. Camino Financial is a fintech platform pioneering affordable credit to underbanked small businesses. We predominantly focus on investing in communities of color, and we've deployed now, let alone raised, but actually placed close to $100 million in capital into the market. And that took us a while to do. We've been lending since 2016, but we actually expect to do $1 billion in a fraction of that time. So that's how fast we're growing, and that's how big the opportunity is. And that's honestly just the tip of the iceberg. We're able to power this experience using AI and also the low-cost infrastructure and resources associated with being a designated community development financial institution. So altogether, we refer to ourselves as a neo-CDFI, and we're truly pioneering affordable credit to underbanked small businesses with the goal of building generational wealth in our communities.
Amazing. And of course, taking a step back, why or how did you come about focusing on a fintech platform for the Latino population in this way? How did the idea come about for you?
Yeah, well, I'm gonna have to go back a little bit into my upbringing, and I'm the son of an entrepreneur that immigrated from Mexico in pursuit of the American dream. And as cheesy as that sounds, it's true. And there are millions of immigrants that do that every year. And in the case of my mom and many immigrants, they see entrepreneurship as their only means of building generational wealth. And so in that context, my mom opened a restaurant. Over the course of her career, opened over 30 restaurants here in Southern California. And so I can never complain to my mom about working too hard. And what ultimately ended up happening was my mom did lose her business. And at that point in time, my twin brother, Kenny, and I were 12 years old. My mom thought that American dream was gone, and she decided to move back to Mexico and restart her life. And it ended up being a blessing in disguise. Growing up in Mexico from 12 to 20 years old was a great experience. But I also always had the itch to come back to the United States and re-pursue the American dream. And also in that process, not only re-immigrated, but experienced for myself what it is to feel like an immigrant coming back. Even though I was born here, I certainly came back with a very different perspective. And that perspective has really shaped my professional life and how I think about financial inclusion. I was lucky enough to go to UC Berkeley, then transitioned and started my career in investment banking and thereafter private equity. Kenny did the exact same thing, and same school, different firms, but we've been roommates throughout the process. And we both work for two very well-established private equity funds that focus on investing in minority-owned communities. One is called ICV Partners. The other one's called Palladium Equity Partners. And both of these firms have an orientation towards investing in minority-owned businesses or businesses that are impacting underrepresented communities. And it was a great operating and investing experience, but there lied more opportunities that we couldn't address as a private equity investment firm. In private equity, you typically don't invest in companies that generate less than $3 to $5 million in EBITDA or profit per year. So these are fairly large companies, but the average size of a Latinx owned business in particular generates around $200,000 in revenue per year. So we're not even talking about small businesses or middle market businesses. We're talking about micro businesses, solopreneurs, sidepreneurs, right? And clearly, private equity is a suboptimal investment vehicle to captivate that segment of the market, which we think is the largest and fastest growing segment of the market. And there lies the opportunity. We've measured it in particular for the Latinx segment at $60 billion in unmet credit demand. And so it's a very large market. We saw the opportunity, we wanted to pursue it, and we were lucky enough to incubate what today would be Camino Financial while completing our MBAs at HBS. I know you're a proud alum. We both sit and participate on the HBSLAA board together, and that was also a unique part of the experience, and germinating that seed that was planted many years ago. And today, as I mentioned earlier, we've deployed close to $100 million in capital. We've raised $20 million in equity, and we plan to exponentially grow all those numbers in a very short period of time.
Amazing. And I mean, that's one of the conversations that I get into a lot. We talk about venture capital. It's a sexy place to be, or for a lot of founders are aiming for venture capital, but a majority of businesses aren't, poised or designed for venture capital, right? And you're creating a market or solution for those other businesses.
By the way,
what did you say?
Yeah, I didn't think so. What's the interesting thing is I come from a private equity background. I know the nuances of finding the right capital that meets the needs and the opportunity that is in front of that business, right? And when you're in the lending business, you're in the business of making money by the pennies and losing money by the dollars. And so exponentially growing a credit business is very risky, let alone, I think there are equity investors will take that risk all day, every day, but it's actually risky for the lenders and the borrowers because it takes time to calibrate that model before you can scale it really fast and in a responsible way. And so as I was thinking about my fundraising journey, VCs weren't on the top of the list, straight up. I think, and I use myself as an example because I think people gravitate towards VC just because, to your point, you use the word sexy, right? It's cool, it's sexy, it's in vogue. But I constantly am reminding different entrepreneurs that I mentor every day that VC can be, in fact, very detrimental to your business model, because doesn't mean that if VCs don't invest, it's because it's a bad business model. It's because it may not be a good fit for the VC investment strategy, where they're looking for moonshot opportunities. They're comfortable, especially at the early stage. It's different at the later stage, but the earlier stage, they're comfortable losing their money on, let's call it, between 4 and 6 investments that they make, right? Kind of breaking even with another 2 and the remainder just going for it. And trust me, they're willing to put, even if you're in that steady state where you're a good business, but you're cash flowing, they're willing to even put that steady cash flow at risk in effort to push you to get that exponential growth. And that's just how the model works. It's not because VCs are greedy or evil. That's just how the model works. They don't really make above market returns unless they get at least 1 or 2 of those moonshot opportunities that really make, call it, well above 10 times their money on the investment.
Amazing. So when you were thinking about building this model, was it always an affordable credit model for underserved communities, or how did you start, and what how have you pivoted along the way? If you could share a little bit of that story.
No, I'm happy to tell you about that, and that's a very important piece of the story. We always knew our North Star was always, in terms of our mission, was building generational wealth for underserved communities. And we fundamentally believe that entrepreneurs are a vessel for economic mobility, period, case in point. We also knew that our mantra is no business left behind. And we've always found that those that have been left behind, by and large, are Black and brown. Let's just call a spade a spade, right? And then if you peel back the onion one step further, you'll see that not only are they undercapitalized, but when capital is made available to them, it's usually made available at pricing that's exorbitantly high, and that pretty much defeats the purpose, because those costs don't outweigh the return on the investment, or at least make it very risky, once again, to make a return on that investment for the cost of capital. So we saw that as a problem that we needed to solve, right? We also saw that as a massive opportunity, because if you can bridge the gap in terms of pricing the capital to be more affordable, but at the same time create a camino, or a path to graduating borrowers to lower cost, lower interest rate loans over time, that's where the magic happens. Because you, in a way, like just like a VC investor, using that analogy, you went in early when no one wanted to go in, right? You priced not at the exorbitantly high predatory rates that people are seeing, but at a rate that you think is reasonable, that's mutually beneficial. But you're also building trust with a massive and fast growing market that when they graduate, because they are, right, you've now created a relationship where you can cross out other financial products and services over time. So we always knew that being affordable was not only an important pain point that we needed to solve for, but it also was a great way to build a relationship with the market that we wanted to continue to create value for.
Amazing. I mean, it sounds, I when you start off, has the mission ever come in tension with the, stay alive motive, right? That's so tough for early stage startups. Like how did you deal or wrestle with that?
Yeah, well, I'll give you a very clear, tangible example, because there's a lot of good intention in investing in Black and brown communities. In fact, there's more attention, and intention than I've ever seen before. And I've been in the impact investing space, right, for over 10 years now, right? And actually more than that, like 12 years. And so, yeah, over 10 years. But nonetheless, and the problem is when the intent doesn't turn into action, right? And that's a very important thing to think about. So you say, all right, we talked about graduating borrowers into lower interest rate, longer term loans. What that means is the rates that you can offer this market probably won't be near prime, super prime pricing day one. You just can't do that. Now, I don't think they should be subprime either. I think there's something in between, right? And then what you do is you give the businesses the tools and resources. Like in many ways, sometimes it's as simple as, opening a business bank account versus operating out of a personal bank account. Like something as simple as that actually makes a big difference in your ability to lower your cost of capital. But that requires training, that requires trust building. And sometimes business owners, you think, oh man, they should know better. And if they do this, then they can wait until they get the right capital. No, sometimes they need the money now. And so how can I create the expediency and the pricing model along with the path to education that gives them my ability to convert more opportunities sooner rather than later, right? But also give that path or camino to optimize their cap structure over time. And there are a lot of people that's like, oh, I won't lend at any rate below 10%, right? And it's just like, really? Like, but your intent is to give money to the market. Yeah, but anything above 10% is predatory lending. Like literally that's what they say, which is not the case, right? Because we are in the business of taking risk, right? And so that's where there's a mismatch, right? Of applying a healthy dose of pragmatism into how you're innovating for the market so that you can still captivate the market opportunity and meet that immediate demand, because time is, essential when it comes to lending into businesses, right? And while still not offering the crazy prices that others are offering for that same level of expediency. And let me give you one quick anecdote, which was, I remember when we started our business, we were underpricing our loans. I mean, straight up, because I went in saying, they weren't below 10%, but they were low enough where we were losing our shirt on lending into
Got
the
it.
market. And eventually what ended up happening was, we found other capital partners that said, hey, we'll give you the money, but you have to increase your interest rates. And we basically talked them into saying, look, we're not going to increase our interest rates, but give us the money at a higher cost of capital, and we'll try to make it work, right? Like, kind of like, almost like it was a loss leader product. Where like, okay, but I learned now that you can't have loss leader products in credit. Remember, you're making money by the pennies and losing money by the dollars. Remember? Okay, but what we found was that within 2 months, we told that lender, sorry, we can't make this deal work anymore. And we're grateful for them to kind of starting that partnership. No ill will towards them. But had we taken that capital and adjusted our pricing, right, that would have defeated the purpose of what we were trying to do. And so we were comfortable going at a business. So there's a range, right? I'm not going to do the loans below 10%, but I'm also not going to do them at a rate that I think is too high and will put the borrower at risk too, just because the cost of capital is very high, right? So I think you need to find the range of, what's the right balance, and then once again build that capacity building element to the experience so people can eventually graduate. And we ended up moving away from that partnership. We did put our business at risk, but Kenny and I at that point in time were comfortable going at a business in order to continue to meet with the underlying mission that we set out to do.
Excellent. One thing I want to dive into, because you mentioned Kenny, you mentioned I know you work with your brother. How is it working with family? I know some of the early, many businesses are family businesses, but on the other side, there are challenges to working with family. How have you all, maintained that personal but also professional working relationship as you're building your business?
Yeah. So what I'll say is we are a very strong unit, Kenny and me. We've been, best friends and partners since the day we were born, literally. And we've been through a lot together, both not only the experience of our mom, but also coming back to the US, going to Berkeley together, working on Wall Street together, working in private equity, just different firms, right? Then both going to HBS, and at face value, you're like, whoa, that's almost so together that it sounds unhealthy. But the nuance is that, especially in the context of our business and even in everything that we've done, you'd rarely ever see Kenny and me in a classroom together. You'd rarely ever see Kenny, if we're at the same networking event, we're on opposite sides of the room. And at Camino Financial, we have very different roles that are very distinct. We collaborate, but our roles and responsibilities are very clearly delineated. So he has the autonomy he needs to do what he does best, and I have the autonomy that I need to do what I do best. And in a way, we've created a very complementary relationship, and we have very complementary skill sets too. So Kenny is the COO of Camino Financial. So he is an operator. He loves to execute, right? He's good at it, but he doesn't enjoy doing all the investor relationship stuff that I'm doing, right? Whereas I'm, as you can imagine, constantly fundraising. I'm constantly recruiting top talent to come to business. I'm very big on the strategic vision and the roadmap associated with that. And I do a lot of these kind of things, which Kenny does too, right? But once again, where do our strengths skew, and how do we spend our time? And I think that's given us, once again, the latitude to be very complementary to one another and to not step on each other's toes. Now, I think that said, just like a marriage, it's very important that we are constantly communicating. And that has been something that's been paramount to our relationship. So we used to have just once a week, or every other week co-founder catch-ups, and now we do them twice a week. And we make it a point to communicate with that high level of frequency, so that we are, just doing well and working together, and making sure we're communicating every nuances in our day to day so that we're always in sync.
Awesome. Awesome. I wanted to dive also into what you were talking about before, as you both were going through this journey, building a business, and you talked about raising $20 million in, plus in equity for, Camino Financial, and 100 million in capital for, the community. Can you talk about, how did that even begin in an industry where, underrepresented founders are getting such a small amount of capital? How can you talk about, like, what are some advice or points of success for aspiring founders that are listening?
Yeah, no, happy to do that. So the first thing I'll tell you is, yes, it's very hard to, and I will go as far as say it's harder for people of color to raise capital from VCs. And I've oversimplified the reason why. And here it is, okay? And I think there are not enough Black and brown people in influential investment decisions, either at the VC level, in the private equity level, and even across other levels in the investment spectrum. And so, why is having more people of color in investment, influential decision-making roles, make a difference? Because ultimately, it's not, and I just heard this today, and I completely believe with it. Everyone talks about access to capital, but we should change the wording of access to capital to connections to capital. And the reason why we use connections versus access is because the money is out there, believe it or not. I've seen people fund PowerPoints, even at first-time founders at crazy valuations, like so many times it almost makes me puke. And they did it they raised it in like a fraction of the time that it took me. Why did they do it? Because they have connections. And the more connections we have with investors that actually have influential decision-making roles within their firms, or leading those firms, better put, right? Then the more likely you're going to see a more diverse set of founders that are being invested in, period. Right? And if you go one step deeper, well, why is that the case? Well, one, the interconnectivity equals visibility. You have visibility on the deal flow that's flowing through communities of color, right? Number one. Number two, sometimes we design I don't want to generalize and say all the time, but sometimes, I'll use Camino Financial as an example, we design our startups around pain points that we experience within our community. And access to capital in the Latinx, or connectivity to capital in the Latinx community, is very important, right? In particular with small businesses. And so I designed around that. I can't tell you how many times I presented this opportunity to investors, and they just didn't get it. They're like, well, why do you need to be Latinx focused? Couldn't these larger competitors eat your lunch overnight? And then, of course, I have all the credentials in the background and the data to support and give them an eloquent answer that would turn any investor around, right? But ultimately, you can only meet them not even halfway. In our case, I think you need to meet them, 11, almost like all the way until the last mile. But that last mile of that marathon requires a leap of faith from the investor. And sometimes I feel like investors that aren't close enough to some of these pain points that you're trying to solve just are more reluctant to make that leap of faith. And that there's a variety of ways. Maybe it's pain point specific, maybe it's your background specific. They don't necessarily think your background necessarily translates into being uniquely qualified to execute that vision, right? Maybe it's a lack of association given the lack of connectivity, but that leap of faith, that last mile leap, or that last step is paramount to turning a no into a yes. And sometimes I think that's where we fall short.
Got it. And when you, I mean, just going back to what you said in terms of reaching out to those investors, when investors ask you, right, like, why just the Latinx population? How do you answer that question?
Yeah, it's a simple question, which is one, it's not just the Latinx population, and two, it's a market entry point into a much broader opportunity. When PayPal started, they started with eBay end users, right? Because they saw that pain point was very unique to people that buy on eBay. And then they're used that as an entry point into a market that would grow into tens of billions, hundreds of billions of dollars, trillions. I don't know now. I'm not going to bet that I understand the TAM of the transaction volume in e-commerce off the top of my head. But the point that I'm trying to make is that it opened up the market, but you always need to create a beachfront product, right, in a niche market to establish your dominance and a strong foundation, and then you expand from there. And so in many ways, our strategy is no different than PayPal starting in eBay. We have a bigger, broader platform vision. We do want to narrow the scope of our focus around underserved communities. I think it's fair to say that that's more than enough to focus on as it relates to our market opportunity. We know and acknowledge that we're probably going to be focused on the Latinx opportunity for a while. Why? Because if you measure the Latinx market by GDP, the US Latinx market by GDP, it's a $2.6 trillion market that's larger than Brazil and twice the size of Mexico. It's growing faster than India and China. And if it was a country, it would be the 8th largest economy in the world. And yet it's grossly underserved. And so we need to make sure that we're giving it the market attention that it deserves. And so once again, I always caveat people as saying our focus doesn't mean we're limited to it. It just means we're focused on it. And we think that given the focus and the size of the TAM, it's a great place to start.
Excellent. So I know we can go on and on. Sean, I want to make sure we have time for our off-camera guest, but if you can share with the audience that's watching online, what's next for Camino Financial?
Yeah, well, what's next for Camino Financial? I alluded to it a little bit earlier, which is we're about to hit the $100 million mark just about on loans. And given how fast we're growing, we expect to hit the $1 billion mark in a fraction of the time it took us to hit the $100 million mark. And why? That's because we've calibrated our credit model. Now that we've really set a very strong foundation in terms of our modeling, our underlying technology and AI that enables us to do it faster, more efficient than anyone else in the market, while offering affordable rates into our member base. We don't call them borrowers, we call them members. And so we want to grow our core product, which is a microloan, into micro businesses exponentially. Number one. Number two, we want to move from a monoline credit strategy to a multi-line credit strategy. And so that effectively means we can start doing, we can leverage the same foundation and infrastructure we put for one product and do that for multiple products. We expect to start with other credit products before we contemplate doing non-credit products, but that's certainly something that's very important. Three, we've been focused on developing our strategy direct to market. And that has enabled us to build the digital brand and the experience around the underlying UX and product that makes our members really excited about working for Camino. Now we're expanding that from what can be called a pipeline business into a platform business where we can offer the same product and expertise, but offer that through enterprise level partners that really see value in the opportunity to offer these credit products and services into their customer base that's underserved and are looking for these types of credit solutions. And it's a win-win solution for both parties. And then the fourth thing that's ahead of us is we recently were designated a community development financial institution. For those that don't know, CDFIs, abbreviated CDFIs, were critical first responders as it related to deploying PPP funding into underserved businesses. As you may know, the first round of PPP really fell short in letting that capital touch Black and brown communities. And so as natural first responders, unfortunately, CDFIs were left out of the process in the first round, or in the first part of the first round. And then eventually were asked to step up, and boy, did they step up. And so we are now, and I think this is the tip of the iceberg of a renewed focus and intent on empowering Black and brown communities. And CDFIs have been flagged as the vessels for deploying that type of capital. Now, what's interesting is there isn't one fintech CDFI until Camino Financial showed up. And so we feel that we are uniquely positioned to use technology and AI in order to, in a good way, disrupt the space. And that's something that we're in early innings for, but we're really excited about the opportunities as a CDFI.
Well, thank you, Sean, for sharing that. There's a lot of work to do, and I'm glad you're focused on it. So thank you, everyone, for watching. This is RBL1 Live. We have Sean Salas, CEO of Camino Financial. And thanks again for joining us tonight and sharing your story, Sean.
You got it.